Okay, to continue on with our example, let's look at the preparation of the cash flow from financing activities section. You may recall that for financing activities, we're going to look at our long-term liabilities and our equity. Those are the two areas of the balance sheet that would include financing information. So if we look at liabilities, we have two long-term liabilities. We have a note payable and bonds payable. The note payable decreased from 50,000 to 40,000, so it decreased by $10,000. And if we go to our information from the general ledger, we see that note payable was paid down by 10,000 and there were no other borrowings. That tells us that that $10,000 payment is the only thing that impacted that account. And so we have a cash outflow of $10,000 for payment on the note payable. Then if we go back to the balance sheet, we have bonds payable, which is also a long-term liability. And we can see that bonds payable increased by $20,000. Now, we already actually looked at this piece of information, but in item number 3, it tells us that bonds were issued in exchange for land. What that tells us, again, is this was not a cash transaction. So just like we left land off of the investing section of this acquisition of land off the investing section, we're going to leave bonds off the financing section. It would be misleading if we indicated that these bonds were issued in exchange for cash when indeed they were not. So that basically means we're through with long-term liabilities. We'll look at the equity section. And we see common stock went up by 50,000 and paid-in capital went up by 10. Again, moving down to the other information, what they tell us is that common stock with a par value of $50,000 was issued for 60. Well, that bears out what we see here because we know that common stock is going to increase by the par value of any issuance, which would have been the 50,000, and paid-in capital would increase by the difference. Well, if we issued that common stock for 60,000, then the difference would be 10, and so that's what our paid-in capital is going up by. So if we go over to our financing activity section, we see issuance of common stock for 60,000. That is an increase in cash, so it's a cash inflow. Then the only other thing that we have in equity are retained earnings. Retained earnings goes up, we know, by net income, which we account for as an operating activity, but it also goes down by dividends. The payment of dividends to our stockholders is a financing activity. And we know from the other information that dividends were declared and paid during the year. What we don't know is how much, but we have enough information to determine that because notice what I've done here. I've put a formula in here wherein I have taken the beginning balance of retained earnings and I have added to it the net income, and then I subtracted out the ending balance. Because any difference, if net income plus beginning balance does not equal ending balance, the difference is dividends. And what that shows us is a payment of dividends in the amount of $15,000. So those are our financing activities. If we add those up or net the outflows against the inflows, we get cash flow from financing activities of $35,000. Our increase in cash for the year is the sum of the cash flow from each of the 3 activities, with a $65,000 inflow from operating, a $10,000 outflow from investing, and a $35,000 inflow from financing. That's an increase in cash of $90,000. Our cash at the beginning of the year from the previous year balance sheet was $40,000, and we add that gives us $130,000 for end of the year cash. And to make sure, that number has to equal the cash on our balance sheet at the end of the year, which it does. Okay. Now, one last thing, those bonds that we issued in exchange for land, we need to account for them. We don't include them in the statement of cash flows, but they're not because they're not cash. But we do need to somewhere indicate we know those things changed. So either at the foot of the statement of cash flows or more frequently in the notes, we're going to have what is called a schedule of non-cash investing and financing activities. And there we're going to identify that we know we issued bonds in exchange for land to the tune of $20,000. That lets the reader know there's a reason we left those changes off the statement. Now, how do we know it's 20? There are two sources. One is, if we look at bonds, we can see they went up from $100,000 to $120,000. Well, that's an increase in $20,000. We can also look at our land account. Land started at $200,000. We know from the one item that we sold $100,000. That would have reduced the value in our land account to $100,000. However, if you look at the balance sheet at 12/31/19, the ending balance is $120,000, not $100,000. So there must have been an addition to the land account of $20,000. That's the land that was issued in exchange for the bonds. And so we can verify by walking through the transactions in the land account that this $20,000 is indeed valid. Okay, I'm going to stop here, and I'm going to do another video that will walk us through the direct method of the operating activities section.